Have you ever seen a situation where two people are in an argument? One person is arguing a point and you know that they're wrong, or they're hanging on to something that has 1% fact, 99% hope, and they just don't want to give up in the argument for whatever reason. Maybe they don't like the other person, everybody thinks they're smart, whatever it might be, but they continue to argue even after they've lost. Like, you're looking at the situation and saying to yourself, like, just stop. What are you arguing this point for? You're making yourself look like a fool. Have you ever seen something like this? It happens a lot. I used to do it all the time when I was a kid with my brothers. Sometimes we still do it, but we like to think we're more mature now and we try not to. But my point is, with respect to today's video, is when it comes to whole life insurance, policy performance, and then tying commissions in, this goes on a lot in the industry, in my opinion. So what we're going to look at today is whole life insurance policies. We're going to discuss how we can design a policy for maximum cash value, something we talk about quite a bit. But then we'll go through different insurance companies and we'll go through what the commission rates are. We're going to use the commission rates that our company, IBC Global, is paid, just for transparency. So you know that the rates we're using are rates that we actually get, which are among the top rates with most life insurance carriers. And when I say top rates, just for some context, is as a life insurance agent, when you start out new in the industry or new with a particular company, they will pay you a commission for business you bring them. However, when you first start, if you're not proven or you have not produced any business, they're going to start you at a very low commission rate. Say it's 50% of the premium going in. So you pay a $10,000 premium, I make a $5,000 commission in the first year. Does that make sense? Okay. Now, as I bring the insurance company more and more business over the years, what they will do is increase the rate that they pay me for business that I bring them. So let's assume, again, that when I first started, I sold you a policy. You had a $10,000 premium. I made $5,000 in the first year. Okay. 5 years later, let's assume my business has grown. You refer me your cousin who buys or who starts an identical policy to you, and they have a $10,000 premium. Because I've produced more business with the company, your cousin starts that whole life insurance policy. It performs exactly the same as yours, but I'm paid $8,000 or maybe even $9,000 by that same insurance company because I've brought them more business. So simply put, as I produce more business, I bring them more business, they say, thank you, you're proven, we appreciate your business, we're going to pay you more now. And there is a cap. You get to a certain level where you cannot be paid any higher commissions. So you will see that in the industry, but the thing I want to mention is if an agent is earning a higher commission rate from an insurance company, that will not impact your policy performance, just so you've got an understanding there. But the policy design and sometimes company selection will impact it. So we've got commission rates on the left with 4 companies, but before I go into that, let's start with what we've got over here on the right, which is policy design. So there has been for a long time this big debate around setting up a policy for maximum cash value and which one gives you more upfront and which one gives you more money long term. What drives me absolutely nuts is when I hear agents say you need to think long term and that's why you should go with the higher base premium. It's like that's complete garbage when you look at the reality of whole life insurance, actual results, not just illustrations, but actual results, and really what corporations and wealthy people do. They're not taking policies with high base premiums. They're not. They're taking out maximum cash value policies. Let's go through some context here. So let's assume you're taking out a policy and you're funding $100,000 per year. And you could take a zero off, it'd be $10,000 per year, everything would be the same here, but we'll assume $100K per year. So that's how much you're paying into a policy. And for the sake of this example, let's pretend that you are taking out a policy with Guardian. We've got this commission rate on the left. We see in red, base premium commission rate, first year, 85%. So if your annual funding, $100,000, the base premium is what? 10%, $10,000. That's where the 1090 split comes from. It represents a 10% base premium and 90% PUA. So with a $10,000 base premium, how much of that base shows up in cash value in the first year? This is your money that you have access to. Typically zero, or a very small percentage. And the reason why is because base premium dollars purchase death benefit initially. And we're using a traditional whole life insurance product here. We'll discuss that more a little bit later. You get zero cash value, or very, very close to it. What do I get? The agent commission, again on the base premium, at 85% would be how much? $8,500. Okay. So that's how much I make in the first year based on the premium alone. There are commissions paid on PUAs. They are much lower. With Guardian, they're a little over 3%. They typically range between 2 and 3.5% depending on the company. But with PUA dollars, why the commission's so low is why? Because the bulk of that PUA payment, between 90 and 95% in the first year, shows up in cash value. It's money you have access to. Again, there is a commission paid, but we're going to focus on the base premium here because that's where the bulk of commissions are paid. So in this example, your first year total cash value might be, it's going to be between 85 and 90%. Let's just call it $87,000. It does depend on the product to a degree, but you'll have $87,000 and the base premium commission was what? $8,500. With PUAs, it might come out to $11,000 or so total. So that's a 1090 split. You see what's paid in terms of commissions to the agent in the first year. Now, if we take that exact same policy with the exact same company and design it differently, where 40% is now going toward the premium, of that base premium, the $40,000 figure, instead of $10,000, how much shows up in cash value? The PUAs do, so the $60K, the bulk does. But what do the commissions look like? You can take $40,000 times 85%. What you could also do is just multiply that number by 4, that 8,500, because we're going from 10% to 40% on the base. Makes it a little bit easier. What does that come out to? That'd be $34,000. And your first year cash value is not $87,000. In an example like this, it's closer to $58,000 to $60,000. Let's call it 58. So, commissions aside, which one would you rather have? It's kind of a dumb question, right? The one on top. It's much more cash rich. From a break-even point, which is when you will get your money back, assuming you continue to fund the $100K per year, you see this one somewhere between 3 to 5 or 4 to 5 years. This one would be somewhere between 7 and 10 years when you looked at it, maybe 7 to 9 years. So you've got more upfront, you get your money back faster with this, you also have much stronger guarantees. Going back to that argument that I think is garbage or baloney, is this. A lot of times we'll hear that if you go with this design, you should have more money long term, because if dividends go up, dividends applied to base premium dollars are more favorable than PUA dollars. Well, if that's the case, put everything in the base premium. Yeah, no, don't do that. But a lot of times we hear that. Here's the thing. We can run an illustration, and we've got case studies that demonstrate this, but we can run an illustration that will show more cash value 30, 40, or 50 years down the road if we pay the exact same amount of money in with this policy compared to this policy. Same company, same product, but this option might show more in cash value on the illustration at the 50-year mark. Which, by the way, what that means is if you're starting a policy at age 30, when you're 80 years old, You finally see more cash value in this product that had the higher base premium. All the way up until then, you had less. Here's the catch though. While we sometimes see that on an illustration, the case studies we've conducted, which are looking at actual policies that have lived the test of time, while these illustrate better long-term performance, a higher base premium that is, we see it actually deliver less. Meaning, long-term, I think I'm going to have more, but then every year, the actual values end up being less than what the illustration produced. And we don't see that, or we see it to a much lesser degree with policies that have a low base premium. In other words, we see low base premiums that pay less in commissions produce values closer to what the illustration displayed. Sometimes it's spot on, especially if the dividend rate has not changed. But when we look at that, how I view it is like this. If I'm you talking to me about a policy and I want maximum cash value from start to finish, and I say, I don't even care what the agent makes, I just want to make sure my value is maximized, because that's why I'm putting money into the product. This is proven and has delivered that. This also has the strongest guaranteed values. This pays a lower commission. Whereas if I sell you this, the 40/60 design, well, what happens here? I'm guaranteed as the agent to make a lot more money, aren't I? Yes, I am, no matter how you spin it. And if I'm looking at 50 years, call it 30 years, if you want to do that, that's typically the earliest you'll see it, a higher base premium policy overtake a low base premium 30 years down the road. I'm guaranteed to make more money, and I'm hoping you'll have more money long term, because the illustration is showing that you will. But again, we haven't seen that actually happen. So imagine if you sell me a policy that pays you a $34,000 commission. You make a lot of money. And you sell me on the belief to go with a high base premium because I'll have more money long term, or I can pay a lot of money into it for a long period of time, whatever it is. And I believe you and move forward with it. But then it doesn't happen. How would you feel? You made your money. I didn't get what I thought I would have. And if we were to go back in time, if I would have went with this, I would have had more from start to finish, and likely would have bought more policies from you and referred you individuals. But you didn't. Instead, you put me in this. How do I feel about whole life insurance, the company you recommended, and maybe even you? Probably not a good taste in my mouth. Now, I would try to have a conversation with you and hope that it was just due to, hey, there was an accident, I didn't deliberately do it, because I don't think people deliberately do this at all. But my point is, when we look at policy design, we do need to be aware of this, because having the knowledge that an agent has, we know what an illustration looks like, we know what we're going to get paid in commission. What we don't always know is how the policy is actually going to perform, other than looking at the guarantees. But what we do have is historical performance. And what we've seen throughout history is those policies with low base premiums deliver much, much stronger actual cash values. Typically, what ends up happening is the illustration that displays the strongest guaranteed cash value to the policyholder. A lot of times I see that deliver the highest non-guaranteed cash value to the policyholder, if that makes sense. But that's an example of Guardian. Now on the left, we've got these different percentages here when we look at the commissions and such. So these again are rates that we currently are receiving from insurance carriers, and they are all near the top. We typically recommend the 4 major mutual companies: Mass Mutual, Guardian, New York Life, and Northwestern Mutual. The reason why is again because of that actual performance. Very, very important there. So when you look at the 4 major mutuals and compare them to whole life insurance products sold with other companies, you usually see this. They're among the lowest. Now you've got Penn Mutual down here at 88%, but we've got that 2x. I'll explain what that means in a little bit. And then you've got a smaller carrier here that pays 130%. It actually tops out at about 136% commission. That's very high, isn't it? Yeah, it is. So if we sell any of these products, based on the base premium, we see what we're going to be compensated. Now, a 10/90 split is possible. Typically with Penn, it depends on how long I'm funding the policy. Age also has a factor here. Typically, the most aggressive we can get a policy is 1585. A lot of times it's a 2080. And what that means is the base premium is going to be anywhere from 15 to 20%. So while the commission rate is a little bit less as to what we're paid, we end up making a lot more if someone moves forward with a Penn Mutual policy, because often it's on a premium that's double the size of what it would be with another company. So I'm making 88% on $20,000 instead of 85% on $10,000. Does that make sense? Okay, cool. So looking at these, here's what we often see. We'll recommend, regardless of what the commission rate is, we'll recommend companies and designs that deliver the strongest cash value. From a design standpoint, we see a minimum premium do that. Sometimes you can go lower than 10% too. With these guys, you can. A lot of times we can get the minimum premium down to 3 to 5% with a Lafayette Life policy. But what drives me nuts is this. Someone will recommend this Lafayette Life policy that pays 130% on base premium and recommend a higher base premium, whether it's a 40/60, a lot of times we see 25/75 or whatever it might be. The first year cash value is 0, but the commission is what? If that was $10,000, as far as the base premium, the commission would be what? $13,000. So take $13,000, multiply it by 4. You have a calculator. It's going to get this number. $52,000 in first year commission. Renewals are paid as well. Renewals with all companies are much lower. I'm going to pull up an example of that shortly. But huge difference there when we look at it. Compared to 1090, let's use Mass this time. So if we use Mass, 93%, 93.5, what would happen here? Base premium, 0 in first year cash value, commission, $9,350. I know they actually top out a little above 95%. That's our rate. We have ours a little bit lower. It's because we've got a good relationship with the agency we work with, and they work hard, so we don't want to take the max rate there. We'd rather take that service. But look at the difference there. And then we'll hear all of this noise as to why one should go with this policy. It's like, all right, dude, as in the agent selling this policy, that's why you're recommending it. Don't pretend that you're doing it for the client and they're going to have more money long term with this higher base premium. It's like, no, they're on the hook for a higher base premium, meaning if they don't want to fund the 100K or they can't, at a minimum, they've got to fund the 40. Whereas if you have a minimum premium of 10,000, you're on the hook for the 10,000. And if you've max funded a policy for a couple of years, it's much easier to stop altogether with a low base premium, because then the dividends and interest need to fund the base premium, whereas this is harder for it to fund. So that's the kind of stuff we see go on quite a bit. Let's pull up some samples here. So what we've got on the left are some products with Mass Mutual, and these are our commission rates. So we've got the first year. Here's a whole life 100 product. Someone funds 100 grand and the base premium is $10,000. First year total commission, including PUAs, would be just about 11 grand. What happens if I make that $40,000? Not $40. What is going on? What happens there? There you go. Commission goes up quite a bit, but the cash value would go down on the other hand. So there it is. We see exactly what the commission rate is. With a high early cash value product, which if we're comparing these two products, most we work with usually take the high early cash value product. Look at the difference there. You paying $100,000 per year. There's the first year total commission, about $3,700. This product works differently, where the base premium credits about 80% to cash value in the first year. So the company can't pay out as much in commissions to the agent. So what they do instead is spread it out. You actually end up making a little bit more over the 10-year period. And you can see that in the running total. So here's your whole life 100, big upfront hit, then you've got your residuals. Whereas this, it's a levelized commission for the first 5 years, then drops off a little bit. But you'll notice by the year 9 mark, 9 to 10, you've got more with the bottom option compared to the top option. So an agent would make a little bit more there. The policyholder would see a lot more money up front and long term when you look at the two products now. A couple of years ago, that was different. And then the 10-pay product. So with Mass Mutual, this would be my first choice as a consumer, because this does deliver the strongest cash values from what I've seen. It delivers the strongest cash values, but when you look at the comp, a little bit stronger upfront than the high early cash value, but it's really just the first year. By year 2, you're almost even there. And look at by year 10. That's the lowest, isn't it? See what's going on? Products that maximize the cash value end up reducing the commission. So anytime we're shown a policy or product, it's nice to know this up front, to know, okay, what am I being shown and which one is really in my best interest compared to the agent's best interest. And we show multiple companies and products. Here's Guardian. Guardian's base premium rate is lower than Mass Mutual's initially. They've got a little bit higher PUA rate, which is why the lifetime value over 10 years is stronger with this one. Then you've got their 15-pay product, their 10-pay product, then also their Executive Strategies whole life product, which is similar to the high early cash value product. Then when we look at another carrier, it's Lafayette, same 10K base premium, huge difference there when we look at it. And there's not many, but there are times people do want a policy with Lafayette Life that we work with. Of course, we let them know up front the pros and cons, throwing commissions out the window. Here's policy performance, here's the track record and such. If they're still comfortable with that, that's okay. But what we want to make sure of is that no one feels like we're putting them in a policy, it under-delivers, and then they find out after the fact, we made this. And it's like, all right, you made that at my expense. Like, that's what we do not want no matter what. But there's the difference in commission rates. Big, big difference. So a lot of information here. And again, the purpose of this is really just to provide some insight as to policy design and commissions. When we look at performance of whole life insurance policies, what we've seen, major mutuals do deliver among the strongest results, along with a minimum base premium. Policies with higher base premiums sometimes can illustrate greater long-term value, but we have yet to actually see that occur. So that's why I'm hesitant with it. And that higher base premium does incentivize me to make that argument where I can say to you, you should have more money long-term, and then I'll view it as an agent as, hey, I make money too, this is great. But again, the issue is, if that doesn't actually happen for you with your money going into the product, that's where it's not a win-win. It's a win-lose. It's a win for me, lose for you. Like we can't do that, because if you're in business and you practice that with your clients, where it's a win-lose, you win at their expense, you're not going to have a good reputation. And long term, I do feel that business will decline as a result. That's just my personal opinion and beliefs on that. Anyway, I do hope that this was valuable just in providing some insight and such. If you have any questions about the products you're reviewing, whether they're illustrations with us or policies you've seen before, please let us know, let your agent know, and we can definitely discuss it and show you how to maximize the cash value. Thank you so much.